The Federal Reserve called it on Wednesday. The U.S. economy has achieved a soft landing. Cue the fireworks. Hey everybody, thank you so much for checking the channel out today. My name is Agabus. This is your financial education channel. And today is Happy Stock Day. Boy, was the market in euphoria yesterday as interest rates were told to hold for the foreseeable future, and interest rates are going to drop maybe 3 times next year. Oh, market was excited. We're over here at Yahoo Finance to take a look and see where the market's positioning everything for today. Stock market news today. Stocks rise as the Fed pivot fuels euphoria. U.S. stocks gained on Thursday as investors continued to celebrate a dovish shift by the Federal Reserve that helped propel the Dow to a new all-time closing high. The Dow Jones Industrial added 0.3%, setting the blue chip index up to build on its record close above 37,000 on Wednesday. The S&P 500 was also up 0.6%, and the tech-heavy Nasdaq 0.4%. The gauges posted fresh 2023 highs in the wake of the Fed's policy decision, which signals the Fed is unlikely to hike interest rates further and that it could cut rates 3 times next year. That message surprised and thrilled investors who welcomed the Fed's forecast of further cooling in inflation and no sharp rise in unemployment. Bonds rallied alongside stocks, sent the yield on the 10-year Treasury down below 4% on Thursday for the first time since August. Again, quick recap here on the bonds. When interest rates go up, the value of the bonds goes down. But when people buy those bonds, that value then has to come up because of demand. So the yield on it goes down, kind of like that seesaw type of relationship in the bond market. Meanwhile, oil prices moved up 1.7% to come further off the 5-month low hit earlier in the week. It's trading at $71 to $76 per barrel. Eyes are also on central bank decisions elsewhere around the world for signs that the worldwide is moving to an easing policy. The Bank of England kept its interest rate steady, as did the Swiss National Bank and the European Central Bank, though Norway's policymakers raised the benchmark rate in a surprise move. Very curious to see when, and more importantly, the why, that the interest rates start to come down. Are they going to come down just for funsies, or is it going to come down because it's a political year, or is it going to come down because something big has broken? We shall see. Again, over at Yahoo Finance, investors absolutely love the Fed's soft landing. The Federal Reserve called it on Wednesday. The U.S. economy has achieved a soft landing. Cue the fireworks. Jerome Powell resisted grand pronouncements at the briefing, telling the assembled press bluntly, "We're not declaring victory, but everybody else sure is." But new forecasts from the central bank showing Fed officials penciling in a further decline in inflation, no sharp rise in unemployment, a moderation in economic growth, and a 0.75% reduction in the interest rates next year send a clear message. The euphoria in the markets, you've just seen some of these interviews at the end of the day, on Wednesday was largely spurred by the final element of this outlook, which the Fed's latest dot plot suggested 3 cuts of 0.25% each will be coming in by the end of the year, 2024. All else equal, lower interest rates are positive for risk assets. So it sounds like we are going back into a risk-on environment. Let's get ready. But these expected lower interest rates don't come with the baggage that often encourages a central bank to ease its policy stance, which is a downturn in the economy. I just mentioned that. I'm curious if the interest rates start falling just for funsies, or if they're going to come down because there is something that has broken. Rather, the Fed expects the coming year to be, for the most part, a repeat of what Powell called quite a performance by the U.S. economy. Inflation is now expected to come down to 2.4% by the end of next year, just a touch above the Fed's target. However, I have heard some loomings that they might start to target a 3% inflation rate. We'll see where that comes from next year. Unemployment will likely rise, but only to 4.1% from the 3.7% seen in November. As of October, unemployment stood at 3.9%. Even bonds rallied to the 10-year yield on Wednesday, continuing a rapid descent towards 4% after reaching a 16-year high north of 5% just 2 months ago. Also, add on to some of the cryptocurrencies over the last month, such as Bitcoin has topped 45,000. A decline in oil prices that should bolster consumer balance sheets and rebound in dozens of stocks left for dead by investors during the 2022 washout. In the view of the Powell Fed, we are not only back, but we're here to stay. However, this comes on the heels of U.S. bankruptcy filings on pace to reach highest levels since 2020, only a couple years ago. We'll see if this continues into 2024, though. U.S. bankruptcy filings are picking up steam after a 2-year decline, according to a report released by S&P Global Market Intelligence. There were 591 bankruptcy filings as of November 30th this year, just behind 2020's tally of 603 in the same period. By comparison, there were 367 filings at this point in 21 and 325 in 22. You can see here on the chart, Yahoo Finance shows 2023 in line here with just a couple of years. I think earlier in the year we did a report that showed that we were on track to hit some of these other years. So actually, oddly enough, came out better than I think what some people had thought halfway through the year. Arizona State University law professor Laura attributed the 2023 increase to higher borrowing costs, of course, and the ed of federal stimulus checks, of course. Cue the zombie company memes. She pointed out that in 2021 and 22, government aid was still circulating in the economy, and that has changed. Meanwhile, interest rates have run higher in 23, making it more difficult for businesses with debt to refinance. She also pointed out that high inflation, particularly when it comes to energy costs, has weighed on businesses as well. And some people are speculating that the commercial sector should have around $1 trillion of debt that needs to be refinanced in the next year or two. Maybe that's why interest rates are coming down as well. But that's what I've got for today. I hope you stayed all the way to the end. Thank you so much if you did. As always, stay inquisitive, stay informed, and stay subscribed for more. We will see you tomorrow.